Hey traders, Nick Shaheen here, taking a couple of minutes to prove to you that there is a Santa. No, seriously. So I use charts a lot, and I get pushback on the technical analysis and its validity. So today, while in the chat room, I just came across a reality, a perfect example of how machines are actually doing a lot of the trading and how they become predictable and how I can turn it into an actionable thing on a chart. So if I wanted to short the small caps, and I am bearish markets to a degree from a trading perspective, I would not do it going into this line, and I'll tell you why. So also, I am not a Fibonacci guy, but I'm not a Wall Street guy, so everything I learned is from me being an engineer and having a good read on geometry and math relationship things. And I eyeballed, okay, so it's about halfway. Hey, wait, this looks like about halfway. This looks like about halfway. So this is where you see a pattern. So this extension, this rally, if I pick this point right here, and then I pick this top point right there, I'm going to go to the right. So the line extends, but I'm picking the top point right here. See? This is the 50% retracement. So Fibonacci has ratios, whether they're true or not, I don't care. The machines believe in them, so that's what makes them predictable. So it looks like they're buying the 50% dips on the extension, and it's not a fluke. If I pick this bottom and I put it to the top of the rally before the dip, I'm trying to get it right. Okay, boom. Look at that. If you can't see it, the green line is 50%. If you look to the left, it says 0.5, 204.32. Okay, so that number right there, 50%. So that's the 50% Fibonacci thing. So that's twice, and it's not the only two times. So if I pick this one to here, to this rally, so from this bottom to this rally, the 50% is pretty darn close to that dip from here to here. So it repeats itself. I think if I take this one here, it's slightly lower, so there is a gap open here. So I guess eventually they might want to come down and fill this gap. Not every gap gets filled, but it's an incentive for machines to come back, and I call it cleanup. So it's something, right? It's a predictable pattern as opposed to me willy-nilly trying to guess where they're going to buy the dip. But if you look at it, you say, oh, it's very obvious. It's the pattern, the blue-red, the pattern that you have drawn. I didn't draw this pattern. It's more proof that the machines are in charge. This is the regression line. So whatever they're following Bollinger Bands or moving averages or something, they have math that they're using, a combination of things to find levels, and then to make the decision whether to buy or sell, they also need to see who's in control. So clearly the bull is in control, therefore they will default to act bullishly on those levels. That's why I don't short going into this line. In fact, I would try to get long as soon as it touches it. That's why I put the line there. If that fails, I like this line right there. Look, a couple of in the top, indecision below it. So this is also an actionable area. So if this failure, if this sell-off continues down to the 210 to 215, I would catch the falling knife there somehow. In fact, I can do it now with credit put spreads if I know what those are. But the point of this video is not a trade recommendation at all. It's just to prove to you that maybe it's worth it to look into technical analysis. I have nothing to do with Wall Street. I promise you, I am the anti-Wall Street dude. Main Street all the way. Engineer, business person, and figured this stuff out on my own. So this is a daily chart, nothing fancy. You can do the same stuff on any time frame. So this is the 2-hour chart, and you can find all kinds of clues in there too, hidden from ratios and levels and how machine thinks and moving averages and all of that. All right, that's it. 4 minutes. I promised to. We went over. Nick signing out.